Chapter 7, Learning Target 1, this is for the CP accounting class. Explain the impact of accounting events on the accounting equation and demonstrate how to make and post journal entry. So before we get going, there's a couple things we want to cover. First of all, what are the three characteristics of an accounting event? And we're going to be specifically looking at accounting events as compared to business events. First thing that's specific to an accounting event is basically it's specific to the entity for which the accounting records are kept. This is the business entity concept. It also is measurable in monetary terms, and that's a big key factor there, which is the monetary unit concept. And an accounting event will impact the entity's assets, liabilities, and or owner's equity, which is the going concern and periodicity concepts. So what's the difference between a business event and an accounting event? Well, as we just talked about, an accounting event must be specific to the entity, must be measurable, and it must impact assets, liabilities, and or owner's equity. A business event is any activity the company wants to plan and evaluate. Thus, all accounting events are business events, but not all business events are accounting events. So you have to understand that it has to be specific to the entity, measurable, and impact assets, liabilities, and or owner's equity to make sure that it is an accounting event. Business events are not going to be recorded in terms of accounting, whereas an accounting event will be recorded. So let's just take a look at a real quick little example here. The following events occurred during the first month of a business at a local marketing company. Indicate whether the events are an accounting event or provide a short justification for your answer. The owner invested money from his savings account or for startup costs. Is that an accounting event? Answer is yes, it is an accounting event. Assets and owner's equity are increased in this case. Employees hired agreed to sign a non-compete contract. Is that an accounting event or a business event? It's not an accounting event. There's no change in assets, liabilities, and or owner's equity. We're just asking the employees to act a certain way. So it's technically a business event, not an accounting event. The owner pays the first and last month's rent on office space. That's an accounting event. Assets are increased and decreased, and owner's equity is decreased. Computer equipment is purchased on account for each employee. That's an accounting event. Assets and liabilities are going to be increased. 3 employees attend a Chamber of Commerce meeting to generate sales contacts. That actually is not an accounting event. There's no change in assets, liabilities, and or owner's equity in that case. Now, hopefully in the long run it will, but attending that one meeting does not count as an accounting event. A client pays for advertising services performed by the company. That is an accounting event. As assets and owner's equities are increased. The office supply store across the street is planning a major advertising promotion next month. Going with the business entity concept, that is not an accounting event because it really doesn't have an impact on our business. So there's no change in assets, liabilities, and or owner's equity. We might buy stuff from them, but it really doesn't impact anything. So the next thing we want to talk about when we're talking about how to explain the accounting impacts is we want to talk about the accounting cycle. The accounting cycle is basically a 9-step cycle from analyzing the transactions, journalizing them, post the ledger, prepare the trial balance, journalize and post adjusted entries, which will be a later lesson, prepare the adjusted trial balance, which will be an even later lesson, and then prepare your financial statements, and then prepare a post-closing trial balance. When dealing with your accounting events, one of the things you need to realize is that you're going to have a chart of accounts. And a chart of accounts is going to ultimately list the numbers of your of the accounts in which you use. The assets are going to be listed by liquidity. The 200s and the 3 and the 4 and the 500s are going to be listed as alphabetical from those. So when you record your transaction, you're going to record it onto a journal. There's different types of journals that you can use, but we're just going to talk about the general journal real quick here. And it's used to record the impact of an accounting event on the company. Once you've recorded it in the journal, you're going to take it and you're going to transfer it each to its respected ledger. And what a ledger is used to record the impact of an accounting event on a particular item. So it'll tell us the increase or decrease in supplies. It'll tell us the increase and decrease in the amount that we owe, and et cetera, et cetera. So basically you record it into the journal, and then ultimately after you return it into the journal, you're going to post it into the general ledger. So as we get into the impact of the accounting events on the accounting equation, we want to quickly review what the accounting equation is. And the accounting equation is assets equal liabilities plus owner's equity. Assets is what we owe, assets rather are what we own and use and can turn to cash. Liabilities are what we owe, and owner's equity are what we're worth. Okay, so let's just take a real quick, and there's basically, when you look at the accounting equation, there's 9 basic combination of accounting events that you can go through. First one is an asset increasing and also decreasing. So let's just say an example that would be if we use cash to purchase supplies. The next example would be an asset increasing and a liability increasing. That's like saying we're purchasing supplies but on account. The next combination would be an asset increasing and an owner's equity increasing. That's where a customer would be billed for the services provided, or if we sold services on account. The next combination is going to be an asset decreasing and a liability decreasing. So let's just say if you look at that second transaction where we purchase supplies on account, this is now we are paying those supplies. So we'd be paying those supplies that we bought on account. Next one is going to be a decrease in asset and a decrease in owner's equity. So supplies are used in the business. That would come in at the adjusting entry time. The next combination of events that happen is basically when our liabilities decrease and our liabilities increase. So let's just say we take a long-term note used to pay off a smaller obligation. So let's say we owe someone money and we really can't pay them now, so we take another loan out to pay that other loan. That would be that example. And the next example of that, the combination of accounting events we'd look at is an increase in liabilities and a decrease in owner's equity. So that bill for utilities, they repair our fridge, let's say, but we don't pay them yet. We basically have an accounts payable. The next one is going to be, this is going to be a key one, where liabilities decrease and an owner's equity increase. And an example of this would be unearned revenue. Unearned revenue is a liabilities account. We owe the customer a service. Until that service is performed, it is a liability to the business. Once the service is performed, then we take that liability, that's unearned revenue, and once the service is performed, we're going to debit that unearned revenue and we're going to credit earned revenue in that case. We'll talk about that a little bit later. One type of capital stock is exchanged for another one. This is our final example where an owner's equity is going to be a debit decrease and a credit increase. We're not going to go too far into this one, strictly because this is this is a complicated one that we talk about a little bit later this semester. So what do debit and credit kind of signify? Once again, just remember, debit signifies nothing more than left, as in left-hand side of the account. Credit signifies right, as in right-hand side of the account. Nothing more than left and right. Neither one is good, neither one is bad. Just debit is left, credit is right. So how do the debits and credits related to the event, how are they related? Okay, like we kind of talked about. Number one, we said basically if assets increase and asset cash is used to purchase supplies, how would we record that? We would record that as debit supplies, credit cash. For the next one, as assets increase, liabilities increase, or in other words, supplies are purchased on account, how would we record that? We'd debit supplies, we'd credit accounts payable. If assets increase and owner's equities increase, such as our customers billed for services provided, how would we record that transaction in our journal? Debit accounts receivable, credit fees earned. If our assets decrease and our liabilities decrease, supplies such as supplies being previously purchased on account are paid for, we would such as supplies previously purchased on account are paid for, we would debit our accounts payable and credit our cash. In the next example here, that we take a look, such as if our assets increase and our owner's equities decrease, such as if our supplies are used in the business, we would debit supplies expense, we would credit supplies. That's going to be an adjusting entry transaction right there that we'll talk about in a little later learning target. If our liabilities increase and our liabilities decrease, that's a long-term note payable used to pay off several smaller obligations. So we would debit our accounts payable and we would credit a notes payable. The difference between an accounts payable and a note payable is the time that the payable is due. Notes payable are more current. Accounts payable are going to be more current. Notes payable are typically more longer run. Liabilities increase, owner's equities decrease. A bill, so such as a bill for utilities is received but not yet paid. We're going to debit our utilities expense and credit our utilities payable in this case. So our liabilities decrease and owner's equity increase, such as an obligation to a customer is met. This is that unearned revenue, because remember, when someone pays us and says, hey, I want you to do this for me, but I'm going to pay you in advance, we would actually credit the liability account called unearned revenue. Once we perform the service that they asked us to do, we would debit that liability account called unearned revenue and credit fees earned or revenue earned or whatever you use. So if an account increases with a debit and its normal balance is a if an account increases with a debit, is it normal balance a debit or a credit? Well, normal balance means increase, so therefore it's going to be a debit. Next quick question for you. What is the normal balance of an asset, a liability, and an owner's equity account? Well, the normal balance of an asset is going to be a debit because it's on the left-hand side of the equation, and left means debit means left. Liabilities and owner's equities are on the right-hand side of the equation, and since they're on the right-hand side of the equation, they're going to mean credit is what's going to be their normal balance. Now, since expenses are part of the owner's equity, why is the normal balance of an expense an account a debit? Well, the reason why is because expenses are actually designed, they are a contra owner's equity account. They are designed to lower the worth of the company. And therefore, since they're lowered the worth of the company, therefore they're going to have a debit balance. So let's take a look real quick here. Various accounts are affected by debits and credits. For each of these accounts, let's state whether it's an increase or decrease in the debit or credit. Okay, so salaries payable, it's going to be increased by a credit, decreased by a debit, and its normal balance will be a credit. Buildings, which is an asset account on the left-hand side of the equation, it's going to be increased by a debit, decreased by a credit, and also normal balance will be a debit. Accounts receivable, which is an asset account, which is on the left-hand side of the equation, therefore debit is going to be increased, credit will decrease, normal balance will be debit. Sales is a revenue account, it increases owner's equity, and it's on the right-hand side of the equation, so therefore it's going to be a credit, decreased by a debit, and increase, and normal balance will be a credit. Capital stock is an owner's equity account, and therefore it's going to help increase the worth of the company, so therefore we're going to credit it. Debit will be a decrease, and credit will be a normal balance. Prepaid insurance is an asset account located on the left-hand side of the equation, therefore it's a debit entry, will increase it. Credit will decrease it, and normal balance will be debit. Accounts payable is a liability account, and that liability account is on the right-hand side of the equation, therefore a credit will be the increase side, decreased by a debit, and normal balance will be a credit. Utilities expense, once again, it's that contra owner's equity account that we talked about. It's on the right-hand side of the equation, but it's designed to lower the worth of the company, so therefore we're going to debit debit will be an increase for expenses, credit will be a decrease, and debit will be our normal balance. Retained earnings, finally, is basically going to be an owner's equity account. It's on the right-hand side of the equation, therefore it's going to be a credit entry. Debit will decrease it, and credit will be our normal balance. So we'll take a look at another real quick little thing here. Specify in the space below it the effect of each of the following accounting events or assets, liabilities, and owner's equity. Use I for increase, D for decrease, or NA for not applicable. Issued preferred stock for cash. Well, we're going to increase our assets because of cash. Our liabilities won't get impacted, and our owner's equity will be increases, so our owners will be worth more. Purchased office computers on account. Well, our assets are going to go up because of the computers are considered an asset. Our liabilities will go up because we bought them on account. Our owner's equity will not be impacted. Purchase computer supplies for cash. We're going to increase and decrease our assets because our assets of our computer supplies went up. We decreased our assets in that case because we paid cash, and then the other two accounts won't be impacted. Returned defective supplies and received a cash refund. We're going to increase our cash, and we're going to decrease the value of our supplies, which are both asset accounts, where liabilities and our owner's equity will not be impacted. Made a payment on computers purchased above. Well, we're going to decrease on our asset, which is going to be cash, and we're going to decrease on the amount that we owe someone or the liabilities that we have. And there will be no impact on owner's equity. Purchased inventory by making cash down payment with a balance owed on open account. Well, we're going to increase and decrease our assets because our inventory is going to be an increase, and also our cash down payment is what's going to decrease. We also are going to have a liability there too because we still owe them money. So in this case, it's going to impact multiple ones, but it won't impact our owner's equity. That concludes this lesson on how to explain the impact of accounting events on the accounting equation and demonstrate how to make and post journal entries. Hope this helps.